and the setups are the fuel that drives the trend. So going to build a floor and have that floor just be made out of wet cardboard, or do you want to have a floor that's made out of multiple layers of cinder blocks? It's a matter of figuring out what we can reasonably execute given our lifestyle, our beliefs, and what our goals ultimately are. We just wrapped up the first group trading sesh of the year in Traders Mind Chat. This is the recording of it. We spoke about managing trades better in 2020. I know you're gonna get a ton of value out of this. Check it out. Enjoy. Tell us your premise with Tesla. So you saw it. It's been on this tear. How are you intending to trade this?
This was one that I picked up from your suggestion.
Okay.
I just like the setup, and yeah, I guess the target was the 380 range.
Okay.
Big thing that shook me out was after the truck announcement when it dived there.
Mm-hmm.
So after that, I got out of it.
And this is going back to what point?
It would have been November 22nd.
In November 22nd. So we're talking about like right over here.
Yeah.
All right. So and for everybody in the room too, I'm not sure if you could see it on your screen, but this upper left there, this is a monthly chart. This is a weekly chart over here. We've got the daily, 2 hour, 30-minute, and right down here, this is a 5-minute chart. And so so Anthony, were you looking to get in on the pullback?
No, I was in it already.
You were in it on the 21st.
I was in it on November 4th, and the 21st is when I got out of it.
November 4th. So you got in back here. So I'll just make this chart bigger. So November 4th. Somebody just popped something into the chat. Ardash, can you explain your stock picking process? Yes, we'll go through that too. For right now, let's talk about Tesla and trade management, and then right after that, we'll talk about the stock picking process and how we can find different stocks. And it'll be different for everybody. I like to share what I do because it's something that's worked for me. It's a process that I've refined over the years. And I believe that trading is both art and science, and that the way that we will trade best is going to be the way that, one, fits our beliefs, and two, fits our goals, the goals that we're trying to achieve. And number three is going to be trading in a way that fits our lifestyle, right? Because we could see a trade setting up in the middle of the day, right? Like let's say we find a great day trade, and I used to find day trades all the time, and I'd be like, oh man, like let me participate and get in, and then that was when I still had my day job. And then all of a sudden I would get a call from the boss, have to leave, not look at the trade, and then it would go sideways and I'd end up losing far more than I had intended. So it's a matter of figuring out what we can reasonably execute given our lifestyle, our beliefs, and what our goals ultimately are. A little bit of a tangent there, but hopefully it was worth it. So here's what we saw back then, right? So Tesla had gapped up, nice breakaway gap, started to run, and then came back in and consolidated. So it broke out back here on the 4th. It started to break out above a real short-term resistance level just a couple of days at around that 318, 319 level, poked its nose above it on this day, closed below it. For me, and everybody trades their own way. I'm the type of trader that will execute based off of price movement and not wait for the volume confirmation, because I would much rather be in as price triggers versus waiting for the volume confirmation. Then if the volume is confirmed later in the day and prices already moved, then I might have missed the move altogether, or have a not as strong of a reward to risk, or less than what I would have planned otherwise. So that would have triggered the move, and the stop loss then would have been below here, right? Because this is the most recent low, that 309.80 level. And even on this day here, it was an outside positive reversal on the day. For anybody that's unfamiliar with what that means, it just means that price completely engulfed the prior day and finished positively. So positive outside reversal.
Just really quick. I mean, going into that, so that massive move up on volume, and then we have the down days 1, 2, 3, 4, 5, 6. But look at the dry up in volume. So,
Yeah, that too.
So although I look for volume confirmation, any volume greater than the prior day, especially on pullbacks, is a positive. So how much lower can you really go before it actually made that move? So it's building a case and of things on why it was getting interesting, and definitely that they were. I forgot who said he got into it, was what was the prime. A great spot to get into it.
Yeah, definitely. So for volume as well, yeah, well, tremendous volume, like 2 days in a row, and then it consolidated on much lower volume. And not only that, when you have a huge move like this, I like to see the tightness in the price action, and it's kind of like the price is biding time, right? Because you had this gigantic rally. Let's just measure the move, right? So in one day it made 18%, and then in 2 days it rallied almost 30%, or about 30%. That's huge, right? It went from about $250 all the way up to 330, right? In just 2 days. That's insane. So yeah, to have a little bit of a consolidation, and then to have that consolidation be so tight, right, relative to what it was, that's great too. And it was allowed time for these other moving averages, the 5 and the 10, to catch up and start supporting these levels down here, well, which is another thing that I wanted to point out too, because this conversation started around the idea of managing stops. I like to have multiple things that will support a certain zone. So like right here, we have the most recent lows. The price structure is giving potential support for this area around 309, 310. It's a psychological number, right? Like round number. And then you have the 10 EMA starting to play catch up. And so now you have a moving average there as well. There could be a bunch of other things too, but the more that you're able to layer, it's kind of a lot like, are you going to build a floor and have that floor just be made out of wet cardboard, or do you want to have a floor that's made out of multiple layers of cinder blocks? That's what I'm starting to see this year as. And when it starts to line up on other time frames too, that adds even more to the potential level of support. Let's see if that was the case over there. So 309. Let's zoom. And this is something else that happens as well. Prior resistance can turn into a fresh support level too. So we want to be aware of other time frames. Anthony, you got in here and you said that you ended up selling over here. Is that right?
Yeah.
And so, well, what was the goal of the trade?
Well, the 380 was kind of the target. So
380
before
was the
that drop,
target.
I think I just had a stop loss. It was a bit higher than what the drop was, but
Yeah, I remember this now. So this was, uh, yeah, it was about a 4.5. It was the reward to risk ratio was about 4.5. Right. So for every dollar
yeah,
that we put at risk, we had the potential to make about $4.50, well, which is amazing. And so, as price gets closer and closer to our target, whoops, did not mean to do that. Um, Let me see if I could raise this little level. Nope, that's not working. But as price gets closer and closer to our profit target, if we're not raising our stop up along with it, then the reward to risk is going to get more and more out of whack, right? So at this point up here, we've only got about maybe 1 R left, right? Like if we're talking about this trade in units of risk, let's actually just draw it out real quick. I think that might be useful. So let's get a different color over here and get this drawing tool, right? So could measure that as a unit of risk. So we've got 1, got 2, got 3, and we've got 4, right? So at this point, right, at this point, we were at about 2.5 R, right? So if we did not move our stop up, we're risking not just, all the other R, but we're also risking our initial risk too. So it was about 1.5. We were risking approximately 3.5 R to make 1.5 R. And
yeah.
so, question?
But I think at that point I had my stop at 340 ish.
At 340-ish.
Yeah.
So you had your stop right about here. All right. So right at about that level.
Yeah.
And then it gapped against you, and then because of that, you sold.
Yeah. And I was out.
All right. So,
Like I guess the question for me is more like, how do you handle after that gap down? Because it really didn't give it gave a sell signal, but it not like a major signal where you'd want to just forget about it. I guess
oh yeah,
looking
no,
like
so I think that there's a difference between, or what we're talking about then is the difference between how we should manage the trade and uh, how we're analyzing the overall structure of the move, right?
yeah,
It, because you got involved over here, and you were absolutely right to exit that trade on that move there, right? Like you had your stop loss below support. You had a couple of moving averages supporting that level. It made sense to exit the trade there, especially if this was meant to be a swing trade. Um, but at the same time, yeah, you're not you wouldn't take it off of the radar per se, because the bigger move at this point, it was coming down. It was testing this 21-day exponential moving average, and funny enough, that level that you used as your support ended up being the next breakout level.
Yeah, in hindsight, yeah, it looks like that. Might have been
So
a good entry at like what was it? 345 level would have been a good re-entry.
yeah, somewhere in that neighborhood. But I think that it points to like so it's here's something that that's worth pointing out. When I used to be in trades like this, and it would move against me, and I would get shaken out, I would just kick myself, right? Like, oh man, like, well, why did I exit there? Why didn't I get back into the trade again? And in kicking yourself, what you end up doing is like messing up your mindset for the future trades. You're taking your eye off the like potential another move, and you're not giving yourself credit for having done the analysis correctly, right? Because this is a support level, right? That support level was violated. Something else that we'd know is that support turns into resistance when it's violated, and resistance turns into support when you get the breakout. So that's the right level. You were correct. Then it started to consolidate right below it. And that level also lines up very closely with this high right over here, right? It breaks out again, and yeah, that would have been a great spot to start participating again.
If you were going to re-enter on that 345 level, like how do you determine what the target would be? Because if it's the same target, it's not a worthwhile trade. But
Great question.
would you be thinking it'd be able to go higher?
There's a couple of ways that we could try to figure out what the next profit target should be, right? So if so, let's say let's get rid of this, or actually, I could just move that up. So let's say we wanted to get in here about that level, and let's say that we were still using the same one, right? So that's making be like, oh, like it's only about like it's right on the cusp, right, of giving us the 3-to-1 reward to risk, right? So maybe you take it, maybe you don't. If your name is Michael Lamott, you're not taking it because he's super strict with trades that he takes for reward to risk. But we could try to find the potential target another way. We could try to use a Fibonacci extension and see where that lands us. Lands us right in the same ballpark that the first level, the 1618, which is an important level that lands us right in that same neighborhood of about a 3-to-1 reward to risk. Part of it might be like, how far do you think that it's going to go? Maybe we look back and see that major volume and how price was acting, and like, you know what? I do think that it's going to run further than this over here, and I want to participate to just see like how far it's going to go. Or you might say that this is the first target, right? You would sell something at this target, but you would continue to hold at least a portion of the trade while it runs. And that's something that that I try to do on every trade. If I hit the maximum target, I'm not selling everything at the maximum target. I'm still holding on to a piece. So that way, if we get a move like this, then I'm still participating.
Yeah. Well, I was thinking another way to do it would maybe be like on that drop down, you're still in a bit of a profit. Would it make sense to just sell like maybe half your position and the other half you keep at break even just to see what happens? Or if you start doing that, is that getting into too much risk?
So the idea then, so if we were back here again, and let me make this a little bit more opaque so we could see it clearer. All right, so what you're saying then is basically, should you have sold a portion of it rather than selling all of it on
Yeah,
that day?
because at least if your rest is at break even, you're not going to lose on the trade.
It depends on how much you want to give back.
Yeah.
So, and there'll be times where you have a Tesla trade, and if you held on, you would come out with a massive win like this that's still running. You would need to back test that strategy over the other trades that you've taken. So what I would do would be to look at the other trades that I've taken over the prior year and apply this kind of selling strategy to that, and see what would the outcome have been. Would I have been better off if I gave myself more room on the trades, or am I better off cutting them, right? And understanding that, yeah, there'll be a couple like this that I end up missing if I don't get back in at around this other consolidation level, right? So what we're starting to talk about now, I think, is not just the management of the individual trade, but the how do I re-enter if I do get shaken out, right? Like, let that be part of the plan.
Yeah. Yeah, I did back test quite a bit of my 2019 trades, and that was a big theme. Was some of them are good winners, but they could have been a lot better.
Mm-hmm.
So just probably gotta work on maybe looking at ways to get back in, or not doing all or none decisions.
Generally, all or none decisions. Um, uh, uh, Again, this comes from my own experience and from studying other fantastic traders. Uh, there's very few instances where we want to be making an all or none decision. The first all or none decision would be like if your stop loss is hit, then you're out. But even in that scenario, right, like you might have a bracketed stop, right? Oftentimes you'll see in the chat room if there's like if there happens to be two layers of support, like, well, where's a good example on here? Let's see. Now the Tesla's been pretty smooth, but let's just say for argument's sake that we wanted to enter on this, right? And let's say we were going to have a stop loss somewhere in this vicinity, right? Like right around the 50-day moving average. There's potential support level over there, and let's say we wanted to have another one down here, right? You might want to have a bracketed stop, or even down here. Now that's exceptionally wide, right? Like I don't think that I would have my real stops placed in that way, but to illustrate the point, you could have a strategy that says that you'll place your even your stop losses at multiple levels, so that way you're not completely shaken out of a position if it moves against you.
Yeah. Yeah, no, that makes sense.
Hmm.
Hmm. Hello,
What? Hello?
it's Andreas. Hello.
Hey, Andreas, how are you?
Yeah, I'm fine. I was just thinking now, but when you think like this, isn't it also depending on if you're like early in the bull market or late in the bull market? Uh, or do you think that way? Like give it more space in the beginning of the bull market?
Hmm.
Or
Interesting. So, uh, I used to think that way quite a bit. I'm just moving my other charts in here. Can you guys see the indexes now?
yes.
All right, great. So, so yes, the health of the market does factor in, and where we're at in the market does factor in. But uh, I used to be the type of trader that would say, oh, like right now we're in the later stage, and so I'm not going to participate. And well, what I ended up finding was that it like I would end up relying more on my own analysis versus what's actually happening, right? Like I well, what I've come to understand over the years has made me a lot more humble in that the market could go far further and faster than I can ever anticipate, and it could do things that I wouldn't think that it would do. So I would much rather follow what is happening versus trying to say that, oh, like right now we've run we're up like 26% on the euro, like for the 2019, just started 2020. Since breaking out of all-time highs, now we're up 7%. We're due for some kind of a pullback, and then not participate for those reasons. Like like I think that it's if we want to
Because
find something, if we want to find reasons, we can find them.
Hey, Michael,
Yeah.
wherever you look, you'll find what you're looking for.
Yeah, thank you, Sean. Oh my God, yeah, you guys that haven't seen Sean's post in the chat room, definitely go check that out. It was a great post. Actually, I've got the window up on another screen over here. Let me scroll down real quick.
You
It's
know,
it's
I mean, going back to
it's right here.
it's a double. I mean, there's two sides of the coin, and that same thinking is gonna, when the market eventually turns south and turns into a bear market, that same thinking can keep you in the market and be like, hey, the party's just starting, it can't end now, and you're gonna be buying the dip, and you're gonna be throwing money out the window and wondering why it's not working when your own bias is preventing you from seeing the big picture. All the great uh, market players, Minervini, Brandt, David Ryan, they all say the same thing. You could feed them charts underneath the door, they're cut off from everything, and they would still be able to make money. And they're not looking at indexes, they're just looking at individual setups. And when you add in all of these noise, these other outside factors, it can become noise that prevents you from performing well or saving yourself when things really go south.
Mm.
So
Yeah,
it definitely it's hard to manage all of that stuff, and with this looking for setups, and I'm big on the VCP and volatility contraction, and what are all these setups that we're looking at? We're looking at price patterns that dictate a good reward to risk ratio. And what does that look like? It's a volatility and contraction, because when that happens, the stock is doing something that we can visually see, and it's acting normal. And when it starts going outside of those parameters and it blows past our stop, it's now acting abnormal, and we don't want to be a part of it. If it blasts to the upside, that's in our favor. But we're looking at for patterns in the charts that we can actually visualize and see what's going on. And when things aren't going how we thought they were, that's the exit door opening for you. Be like, hey, you might want to think about jumping ship if you're in the stock. So all of these things. I mean, do you really want to? Would any of you guys enter into a stock that has a volatility of moving 20% a day? Hell no, I wouldn't. But why are these, like, the stop loss is 5 or 8%? It's all based off of a methodology, and like all of these things, I've been around for a while, and you follow all of the gurus and that all of the paths that everybody has leads to the same place. It really does. They just call it different things, and they have different methodologies of finding these setups, but it all leads to the same place. They're all doing the same exact thing. They just call it, one calls it blue, one calls it red. It doesn't matter though.
Right, exactly. And that kind of leads into what I think Ardash was asking earlier. He had typed a question in the chat. I think that's who was asking. Adash was asking about the stock picking process. Yeah, it's all of it is very, very similar, right? So Minervini has his style with a SEPA entry point. Then O'Neill had CanSlim. I came up with my own thing that I call Eagle, because I thought that CanSlim was a little too strict with wanting both current earnings and current sales to be off the charts. Like, I would rather see earnings, sales, and or projections, right? So just one of the three has to be there, and that's how you end up with a stock like Beyond, right? Or even Tesla. Like, I don't think that Tesla had earnings for a real long time. Let's bring up MarketSmith for a while, just for a hot minute. Can you guys see MarketSmith?
Yep.
All right, so now we're looking at Tesla. Tesla still doesn't have earnings. Right? Like all these years, still doesn't have earnings. But the sales are there, right? So Tesla, even though Tesla's like running to the moon, is not a CanSlim stock. And so in O'Neill land, you wouldn't be trading it because it wouldn't pass the criteria. That's why I would prefer, like I'm just looking for, does it have earnings? Does it have sales? Or are the projections off the charts? And if it doesn't have the earnings and the sales, like a lot of biotechs don't have earnings or sales, but there's some kind of projection that this might cure cancer, right? Like, I want to be able to participate in an idea like that. So that's why it's got to be one of those three. If it has all three, amazing. If not, then I'm glad to have just one of the three. And that's one of the first selection criteria. Other questions?
Was that the Fibonacci extension you had on TradingView? Was that where'd you get that from? The one I have is not as good as that one.
Are you using TradingView?
Yep.
Ah, interesting. So I just come over here to this little tool section. I grabbed this one here, Fib retracement.
Oh, okay. Oh, I didn't know that was there.
Yeah, and well, when you draw the retracement, it extends up and gives you the extension levels as well. So pretty convenient.
Oh, you know what? I might not have that on my version. That could be why.
Mm-hmm.
Oh, no, I do. Yeah. Oh, good. Thanks.
Yep. And that's just one thing that I look at. Like the other things that I'm looking at for price targets too, like I'll look for the classic target zones, right? So let's say it might be easier to just pop open MarketSmith again and because they have the pattern rec. Don't have to go hunting for any of that stuff. Let's see. Yeah, so like with this for Apple, right? Like the original breakout from the flat base, classic pivot was 221.37, and then from there, 20% above lands you at about 265. And so that's the first way that I'm looking for profit targets is looking at the primary base pattern, right? So looking at weekly charts and then seeing like, is there a primary base pattern? And if there is, and if it's breaking out from that, then that's the ultimate profit target.
Yeah.
And then sometimes you will get a very smooth move like this where you'd be able to participate in different ways as it's running up. So you might, like if you are trading this from an intermediate term perspective, right? Like let's say you're an intermediate term trader that's buying Apple, you would get in over here at the pivot, but if it's beyond that that chase zone, that about 5% above the pivot, then it like, oh no, it's too extended. But if you are a short-term swing trader, then there's lots of trades that you could get involved with over here. If you're a day trader, there's lots of trades that you could get involved with along the run. It's just a matter of knowing where you're at in the move, right? So, so Apple right now is at a very interesting psychological level. Like it just hit 300. Right, so it'll be interesting to see what Apple could do from here. Will it continue running? I don't know. So far, it still looks very strong. We will see. Not only that, the industry group is strong. It's 27. Like, and so this is the other stuff that I'm looking at too, right? Like so, I'm looking at TradingView. I'm doing most of my or actually like all my chart work in TradingView, but in MarketSmith, this is the kind of stuff that I'm looking at. I'm looking at the industry group rank. IBD ranks industry groups from 1 to 197, and 197 is the worst, right? So 27, that's pretty strong. Then I'm looking over here, right? I'm looking at the different ratings, but more so down here at the earnings and the sales, right? Like, does it have earnings and sales? In the case of Apple, it doesn't, but the projections are off the charts right now. You can see that just based in the move of the price action, right? Not only that, look at the fund ownership as well, right? The fund ownership, that something has to be growing, that G, right? The G in the Eagle system stands for growth. You're looking for growing industry groups. You're looking for growing ownership as well. Quarter over quarter, there's more and more funds getting back into Apple, and there's no sign of selling for this entire move. Right? It's been running since September, and there hasn't been any kind of significant selling volume coming into it.
Do you do all your like screening in MarketSmith for your like weekly prep?
Yep.
Do you use theirs?
Yeah. So all of the screening, like any kind of the fundamental analysis, is coming from MarketSmith. I'll do that part of it in MarketSmith. Idea generation, comes from all over the place, right? Like, so it's not just whatever's passing X, Y, or Z screens in MarketSmith. It'll be stuff that you guys mentioned, right? Like, you guys mentioned a stock. Like, I'll see if it interests me, and then if it does, it'll go onto a watch list. If somebody mentions something on a stock puts board, or if I see something trending, then I'll go investigate it and see if it's something that I want to add. Sometimes an idea might get mentioned in the New York City IBD meetup, and I'll add it from one of those guys. But it's all the ideas are always jumping through my hoops. Like, I'm not just going to trade something because, oh, the Mark Minervini likes it. He's one of the best traders in the world, so therefore I'm going to buy it. Like I need to come up with my own thesis of how I'm going to trade it. Like, I've fallen into that trap way too many times. When I was trying to learn, and then like as I started to learn, and I started to and this is another trap too. I started to think that well, like I'm better than this guy. Like look at what they're doing versus like looking what I'm doing. There's so many mental pitfalls that you could fall into. The main thing is to you have your trading plan, you have your trading methodology, and you're trading it the idea based off of what your process is. You could get an idea from somebody else, but it still should jump through your hoops. You're the one that's ultimately trading it, so you're pulling the trigger on the entry, you're pulling the trigger on the exit. It's got to fit your parameters. Other thoughts? Questions, ideas?
I guess going back to the previous question about like what stage the market's in, maybe not what stage it's in, but if you look at like the NASDAQ, for instance, like, isn't it pretty obvious that it's not going to go much higher just historically? Like, how do you manage your account or your trades when you
was
look
it
at that
Livermore
sort of
that
thing?
said that the market is never obvious?
Yeah, well, I guess I think obvious is the wrong way to say it, but like if you look at how far it is above certain moving averages, like historically, it doesn't really get much further above the moving average before either consolidating or going down. Like, does that enter in your thought at all, or is it just you just look at what's setting up and trade from that? Because I've fallen into that trap before.
Multiple ways to analyze the market, right? Like I wouldn't just look at the Nasdaq on the daily chart and say that okay, is it extended? Sure. Have we been running for a little while? Like, absolutely. But there's other factors, right? So I would be looking at the Nasdaq. I'm looking at the number of new highs versus new lows being made. I'm looking at the sister indexes. What do they look like? I'm looking at the other time frames. Well, what do those look like? I'm looking at, well, what stocks are setting up, right? Like, are there a lot of setups? Are there, and the setups are the fuel that drives the trend. So if there's a lot of stocks that are setting up, especially longer term or intermediate term setups, then there's potential there, right? Like, if we look at, let's look at the NASDAQ for a minute, right? Like, so far, right? Like, if we're looking at this breakout here, right? Market consolidated about 20%, took about a year and a half to do that, and then finally broke out. And then from there, the market ran a little over 50% before it consolidated again. Then what happened? Market consolidated, fell about 24, 25%, and did it in a little over a year. And so far, we've run about 10%. So if we're looking at it from that vantage point, if it does similar to what it did back here in 15, 16, 17, and has that run like it did uh, from 17 through August of 18, then we've got a lot of room to go.
Yeah.
The market could do a lot. So that's one of the reasons why, like I just try to approach it and be open-minded. That yeah, if we're looking at it from back here, sure, the market does look extended. What does everything else tell us? And I try to let that influence my perception of the story. And I'm trying to allow the market to tell me what to do next, how I should be operating. And I allow it to draw me into the market deeper, and I also allow it to kick me out as well. That's why we have multiple types of exits too, right? Like we don't just have a profit target and a stop loss. We also have those backstops. We also have trailing stops, right? Or at least that's what I do. And in addition to that, we're not making these all or none decisions. We're scaling out of the market. Some of us scale into the market. I scale in a sense, in that I will take my full 1% of, like, so if I'm going to risk 1% on, say, Tesla, and I got in over here, and then it sets up again, then I would add another 1%. And put on additional risk that way. So I could have multiple layers to a position if it just continues to run and sets up again and again without stopping me out or what have you. And it's kind of like what some people refer to as trading around a core position. Part of the idea too is, yeah, like what is setting up, right? So if I find 20 or so stocks setting up out of a bigger watch list of about 100, right? If 20% of the stocks that I'm interested in are setting up, then that's a lot of fuel to me, right? Like for the style that I want to trade, the market is telling me, hey, this is time for you to participate. Great. And then the question that I'm asking myself is, how much of my portfolio do I want to be at risk? Meaning, like, so if, let's say the most that I want if I get stopped out of everything to be down 5%, then I better make sure that I don't have more than 5 trades on at that time. And then like, well, what happens if everything gaps down against me, right? And what's the maximum drawdown that I want? For me, it's 15%, like if the world collapses, right? Because I know that I can still come back from a 15% drawdown. But on average, right, like if I'm just stopped at everything normally, 5% is my cap. I think there was a question or a comment or something. Yes, no, maybe.
How do you determine like when you say 15%, like, because you never know what, like that flash crash that happened in, I can't remember the year, but that might have been worse than 15%.
Potentially, right? Like, so you're trying to prepare yourself as best you can for a black swan event like that, right? Like, because if you were trading, like if you only, so like, let's say that you wanted to prepare yourself for like, oh man, like what happens if we get another flash crash? Like I'm going to only risk 1% of my portfolio at any given time, right? Like not per trade, but the entire portfolio. You'd never make any progress.
Yeah.
Or it would be very difficult to make progress if you're risking such a small percentage. Maybe if you're a day trader that is going in with your full account on one trade and you're only risking 1% of capital, then that might work. But for the intermediate term swing trader that's managing 3, 4, 5 positions, give or take, then if you're only doing 1%, like it would take an extraordinary amount of time to have the kind of returns that you want. Other thoughts on that? Sean, do you have an idea on that?
Do I have? Why you gotta pick on me?
That's what happens when you know your shit, man. People pick
Ah,
on you.
oh man, uh, man, you just gotta. I mean, you can only control what's in your power, and worrying about all of the end of world stuff, and that just detracts from your focus and energy. And we don't know if the market's going to crash tomorrow or in 5 minutes from now. But all we can control is what we do every single day. And you have to mitigate risk. You have to put in the time and just kind of learn to go with the flow. And that all comes from doing your own analysis and day in and day out, and coming up with with what Michael said, with looking at the number of setups versus what the market is doing, what's normal versus abnormal action. If you can find any chart and you can zoom in on the 1 minute chart or 5 minute chart, you can find a bar that would scare the any trader. But if you zoom out, you're like, oh, it's only a 0.5%, but the bar looks scary. So if you find yourself getting into the pitfall of, oh my God, the market's selling off, like zoom out, look at the weekly chart or the monthly chart, and is the market acting normal or abnormal? And unfortunately, you have to go through your own analysis and put in the seat time to figure out for yourself what's normal, what's abnormal, and is the sell off or the pullback contained within a certain percentage that you define, that is based off of past history of what's what is not scary at all, but just a normal market reaction. I mean, at any point in time with the market going on a tear, any pullback with 5 or 10% would be normal. But I guarantee you, Twitter and stock twits, people are going to be saying it's the end of the world, and those are the people that are going to miss out on the next move because they're too busy, scared of what's happening now and not seeing, preparing for the potential setups that are now building bases or pulling back, and they're going to miss out on the next move. So everybody always calls bullshit, when the market's going up. And then when it goes down, everyone says, I told you so. And then they're the same ones that call bullshit and they miss out on the next move. It's a never ending cycle.
And that's why I like to think of the market as seasons, right? And like for anybody that's been to the mind dump sessions, right? Like that, like the way that I'm analyzing the market, like forest, trees, and leaves, right? Like you need to understand that, like the seasons change and so does the market, right? Like you could see what's happening from the forest level, right? Like that's your monthly chart. But if you're only looking at monthly charts, then you're going to be late to the party, right? Because by the time that this looks like it's selling off, you could have been out ages ago. But if you're only looking at, say, a daily chart, then you might think that the world is collapsing. And to Sean's point, you zoom out a bit and, nothing's wrong at all. It would be the equivalent of like walking into the forest, picking up one leaf off the ground, being like, uh-oh, winter's coming. And then you look around at the rest of the trees and everything is fine. And it's just like one dead leaf on the floor, right? It's important to take all the different things into perspective, especially when we're analyzing the overall health of the market. And the same thing is true for an individual trade as well. We want to be aware of not just one time frame, right? Like this is a 1 minute chart of Tesla, and oh my God, it blasted off, and now it looks like it's rolling over. It's below its 50 moving average, right? A 51-minute moving average. But then you pop back out to say a 30-minute chart or a 2-hour chart or whatever you want to look at, and it's had a major move. It's consolidating, and it seems like it's getting ready to set up again. So lots of perspective. And with that, it is 1 o'clock. So we're going to wrap things up here. I hope this was helpful for everybody.
Thank you so much for watching. I truly appreciate it. If you would like to get access to coaching sessions just like this every single week, all you have to do is join Traders Mind Chat. Now, you not only get access to this, you also get access to the room where we're posting research analysis, all this stuff, all this discussion every single week, and we're going deep into your questions and making sure that everything is answered. So all you have to do is go to Traders Mind Chat. I'm going to put the link somewhere over here, and I'll also put it down in the description. Just click on that and you will be able to test out the room. The room, you can test it out for free for a full week, and then it's only $20 a month after that. The value cannot be beat. I hope to see you in there.